One question I get a lot is one that's around refinancing versus recasting. A lot of people I meet, they don't know the difference between a refinance and what's called a recast. So I want to explain that today and share it with my viewers out there because it could save you tens of thousands of dollars whenever you're doing a mortgage loan or potentially not having to do a mortgage loan. Here's what I mean. So a refinance, it's pretty basic. A refinance is where you're just taking a certain amount of money that's financed at a certain interest rate and replacing it with a new lower interest rate. So I might take a $500,000 loan balance at 6.5% interest rates, and if the interest rate's gone down currently to 4.5%, I will replace that loan with a lower interest rate loan and go and pay this other one off. What's great about a recast of a mortgage loan is you get to keep the same and preserve the same interest rate that you currently have. So if you got a historic low interest rate of 3.75% a few years ago, and you don't want to refinance, but your balance on your loan's gone down drastically, you can do something called a recast. And a recast, all they're doing there is they're now taking what the new lower loan balance is and recasting it over the term of the loan and how many months you have left. It usually happens when somebody makes a lump sum payment towards principal balance that drastically reduces loan balance. So here's two scenarios that a refinance and a recast might help out. So a refinance, right now currently you took out an interest rate in the last couple of months and you got an interest rate of 7 to 7.5%. But with interest rates recently dropping, maybe going down into the fives, you could say, Sean, I could take that mortgage loan from 7.5% down to 5.5%. I currently borrowed $500,000 on my loan balance. So that means if I can drop that interest rate by 1%, it's over $7,000 a year. 2%, maybe $14,000 a year, saving you hundreds of dollars per month in a new mortgage refinance on your monthly payment. A recast, you might have possibly had another property that you sold. Maybe you bought a new property without selling your current one first. And then you eventually sold that property that you used to live in or you used to own. And you had, say, $200,000 now that's available from that you made from that property. You could apply it to your mortgage loan that you currently have that might be at that 3.75% from a couple of years ago. And now instead of owing $500,000, you now only owe $300,000. And for a small nominal fee versus refinance costs on the other option, which is thousands of dollars, on a recast, it's a small nominal fee that will readjust your mortgage payment based on the new, much lower loan balance after you made that lump sum principal payment. So recasting, if you got a low interest rate, it's a great option. Refinancing, if you already have a little bit of above market interest rate, refinancing is always a wise thing to look at and look at all of your options. And for more tips like this, and you want to sign up for my newsletter, the contact info is below, but hit that subscribe button for future updates. Thanks for watching.